Hi guys, I am finally back for some more investing and business related content. As you can see, I am shooting from my new pad. This is what has distracted me for the last few months, but it has got me thinking about what is the best use of my money. Do I buy a property or do I invest in the stock market? And in this video, I'm going to pull together some real numbers and come up with a definitive answer. So the first thing to do is compare historical stock market returns with house price growth. So firstly, we're going to look at the stock market, and I'm going to focus on the US market because it is the largest and it's accessible to anyone. So looking back at the last 30 years of the S&P 500, we can see that it has risen at just over 10% per annum on average. Bear in mind, we might not see the same growth going forwards because recently we've seen quite a lot of speculative return versus investment return. So speculative return generally fluctuates over time. So we are due some negative growth here, and this will impact the total market return. So now we're going to look at house prices, and I'm going to focus on average house prices in England because that is where I'm from, but I think this will be pretty representative of most places. So English house prices have risen on average at about 5.5% over the last 30 years. So clearly you can see that this is not as good as stock market returns. And if we superimpose house price growth with stock market returns, you can really see that the stock market returns have broken away in the past decade or so. One thing to note is depending on the start year that you choose, the average growth rates will change. If we look at the last 10 years, the stock market massively beats house prices. And this varies for 20, 30, 40 years. And then if we look at 50 years, the stock market has slightly less of an advantage. In fact, if we look at any time period back from now in the last 50 years, the stock market always wins. The closest that house prices comes is if we take 1999 as a start year, and this picks the peak of the dot-com bubble. So stock market returns from then are slightly less, but on average, stock market returns from then is still slightly higher. So at this point, you're probably thinking it is a no-brainer. Put your money in the stock market, it has always had higher returns. But there is one massive caveat. So the big difference between investing in the stock market and buying a house is you can borrow a lot more money buying a house. So you can buy a house with up to 95% mortgage, and therefore you have so much leverage. And what this does is it starts you off at a big advantage. So you're growing a bigger sum at a slower growth rate versus in the stock market where you start at almost nothing, but you're growing at a much higher growth rate. So to compare buying a house with investing, I have modeled two scenarios. Scenario one, we have a stock market investor. Let's call this person Kathy. And scenario two, we have a home buyer who saves for a deposit in the first 4 years, buys a house, and then subsequent savings are invested in the stock market. And we will call this person Donald. So in both scenarios, we're going to make some pretty broad assumptions. So we're going to assume that they have an income of £50,000 a year. Deductions including tax, pension, student loan, etc. are equal to around £16,000. So the take-home pay is £34,000. Living expenses, not including rent or mortgage, but including travel, contingencies, everything, we're going to assume is £9,000 per year. So this leaves £25,000 for rent or mortgage and savings. So for the renter, we assume they pay around £1,000 a month, which would mean £12,000 a year, and this would leave £13,000 in savings. And to keep it simple, we're just going to assume that salaries stay the same and rents don't increase. So then we have the key differences in the scenarios. So Kathy, the stock market investor, she puts away that £13,000 in savings into the stock market every year, and we assume she achieves average returns of just over 10%, as we've seen historically. And this would result in her wealth accumulating to just over 2.3 million after 30 years. So now we come on to the home buyer, Donald. Now he saves that 13,000, so that after 4 years, he has saved just over 50,000, enough for a deposit and various transaction fees with buying a house. So he buys a £275,000 flat with a £225,000 mortgage. So this will probably get you a 1-bed flat in London, probably around a 30-minute commute to central London. So then I looked up some standard mortgage rates and found that you could get a 25-year mortgage with initial interest at around 2% for a fixed 5-year period. And then following that, you'd pay the standard variable rate at around 4%, which would result in slightly higher payments. Under this scenario, the mortgage comes in at a similar rate to the rent at just under £1,000 per month. So this would result in the same amount of savings of $13,000 a year. And this $13,000 would then be invested in the stock market once the house has been bought. So in this scenario, Donald's wealth is made up of his house value and any stock market returns. So the house value starts at 275,000 and grows at 5.5%, and then any stock market returns grow at 10%. Therefore, total wealth at the end of the 30 years is just over 2.4 million. So showing the results on one graph, you can see that at the end of the 30-year period, the home buyer has more wealth. So these results are highly dependent on the assumptions we made, so we can play around with these to see what happens. So if we increase the stock market returns to say 15%, we have the stock market investor overtaking after about 20 years. Then conversely, we could increase house price growth and decrease stock market returns. So taking the last 20-year averages of 9% for stock market and just under 6% for house price growth, you can see that the home buyer wins by an even bigger margin. Finally, a couple more things to consider are for the home buyer, at the end of paying off their mortgage, they suddenly will have a lot more disposable income to invest versus the stock market investor who will still have to pay rent. Conversely, for the stock market investor, they will have all of their wealth in the stock market, which means that their wealth will compound at a higher rate going forwards. However, the home buyer could just sell their property and put it in the stock market, but then this does open up this whole other issue with tax, so we're not going to go there. Obviously, you have to take this analysis with a pinch of salt because we do not know what's going to happen to house prices or to the stock market, to interest rates, which could surge, which leads to higher mortgage payments. We simply don't know. And then there are the non-monetary things to consider, such as the advantages of having your own home to kit out the way you want it, or conversely, the advantages of renting where you have so much more flexibility. On the whole, however, I do think that buying a house is probably the best thing to do based on these fairly general assumptions that I've made. So I've thrown quite a lot of numbers out there, so if you have any questions, post below, and thanks a lot for watching. See you soon for some more investing related content.